Have you ever placed a trade and later realized your position size was completely off, either too big or too small? That's what we call a sizing error, and it's one of the most common mistakes in Forex trading. What is interesting is that most sizing errors don't come from a lack of knowledge or poor strategy. They come from psychology, from the way we think, feel, and react to the market. When traders win a few trades in a row, confidence starts to rise. That's when the brain says, "You're on fire. Increase your lot size, make more money." But that confidence isn't always backed by logic. It's driven by emotion. Then after a few losses, the same trader becomes fearful and starts cutting position sizes drastically, sometimes avoiding good setups altogether. This constant emotional swing from greed to fear is what leads to inconsistent sizing and unstable results. The truth is, every trader faces two main psychological traps: overconfidence and loss aversion. Overconfidence makes us think we're smarter than the market after a few wins, while loss aversion makes us desperate to avoid pain after a loss. Together, they distort our perception of risk. Instead of following a fixed money management plan, we start trading based on how we feel in the moment. That's when discipline disappears and randomness takes over. Think about it. A trader who risks 1% on one trade and 5% on the next, depending on mood, can't have a consistent equity curve. The market doesn't reward emotional reactions. It rewards consistency. The goal isn't just to find perfect setups. It's to manage risk with the same mindset every time. A professional trader does not think in terms of winning or losing individual trades. They think in terms of long-term probabilities. That's the real mindset shift. To overcome sizing errors, you have to detach your emotions from the trade. Before entering a position, ask yourself, am I risking what I can emotionally afford to lose? And is my position size based on logic or emotion? Stick to a set risk percentage, usually between 1 to 2% per trade, and follow it no matter what happens. Over time, this discipline builds confidence that isn't based on luck but on control. At the end of the day, successful trading isn't just about strategy, it's about self-mastery. The numbers on your chart won't hurt you, but your own emotions can. When you learn to control them, you'll notice that your trade sizes become stable, your results more consistent, and your confidence real, not emotional. Remember, in Forex, the biggest battle isn't with the market, it's with your own mind.